Do you know how much you should be saving in tax-free, tax-deferred, and taxable accounts? Let's dive into the importance of saving money, a topic that's often overlooked but can be a game changer for your financial future. We've all heard the saying, "A penny saved is a penny earned." While it might sound cliché, the truth is, it's a mantra that holds immense weight. Saving money is like planting a seed that gradually grows into a sturdy tree, offering shade and fruits over time. The fruits, in this case, are the financial security, peace of mind, and opportunities for growth that a well-fed savings account can provide. Now, here's where it gets interesting. When it comes to saving, one size doesn't fit all. Different types of savings accounts offer different benefits, and understanding these can help you make the most of your hard-earned money. Enter the world of tax-free, tax-deferred, and taxable accounts. Tax-free accounts, as the name suggests, allow your money to grow tax-free, meaning you won't be taxed on the earnings from these accounts. Tax-deferred accounts, on the other hand, allow you to postpone your tax payments on the funds until a later date, typically when you withdraw the money. Lastly, there are taxable accounts, where your earnings are subject to taxes in the year they are earned. It's like a financial buffet, with different dishes suiting different appetites. If you're seeking long-term growth without immediate tax implications, tax-free accounts might be your dish of choice. If you'd rather delay your tax payments to a time when you might fall into a lower tax bracket, tax-deferred accounts could be your go-to. And if you're looking for versatility with no restrictions on withdrawals, taxable accounts could be the right fit. So is there a golden ratio for how much to allocate to each type of account? The answer is, it depends. It depends on your financial goals, your income, your age, and a host of other factors. Understanding these accounts is a crucial step towards an effective saving plan. So let's navigate this financial landscape together and build a savings strategy that works for you. So, what exactly does tax-free mean, and how does it benefit you? Let's dive right in. When we talk about tax-free accounts, we're referring to financial accounts where your money grows free from taxes. Yes, you heard that right. It's free from taxes. One common example of a tax-free account is the Roth Individual Retirement Account, often referred to as the Roth IRA. With a Roth IRA, the contributions you make are taxed upfront, which means you don't get any immediate tax breaks when you put money into the account. However, the magic happens as your money grows. Any interest, dividends, or capital gains that accrue in your Roth IRA are not subject to taxes. So if your investments do well, your account balance can grow significantly without you having to worry about the taxman taking a slice of your profits. But wait, it gets even better. When you retire and start withdrawing money from your Roth IRA, those withdrawals are also tax-free. Imagine that, being able to use your retirement savings without having to worry about setting aside a portion for taxes. Now that's something to look forward to. However, as with all good things, there are a few conditions. To enjoy these tax-free benefits, you need to stick to certain rules. For example, you generally can't withdraw earnings from your Roth IRA without penalties until you're 59.5 years old. And your contributions must be within certain limits based on your income. So who stands to benefit the most from tax-free accounts? Well, if you expect to be in a higher tax bracket when you retire than you are now, a tax-free account like a Roth IRA can be very beneficial. You pay taxes now while your rate is lower, and avoid them later when your rate might be higher. In conclusion, tax-free accounts can be a powerful tool in your financial arsenal, especially if you expect to be in a higher tax bracket in the future. They allow you to grow your money and use it in retirement without worrying about taxes. But as always, it's important to understand the rules and make sure this type of account fits into your overall financial plan. Now, let's move on to tax-deferred accounts. These are a special type of financial accounts that offer significant tax benefits. They are also known as tax-advantaged accounts because they can help you save on taxes in the long run. The most common examples of tax-deferred accounts are 401(k)s and traditional individual retirement accounts, or IRAs. So, what makes these accounts tax-deferred? Well, the money you put into these accounts isn't taxed up front. It's only taxed when you withdraw it. This means that if you contribute to a 401(k) or a traditional IRA, You can deduct that amount from your income when you file your taxes for the year, effectively reducing your taxable income. Now, let's talk about the growth of your investments in these accounts. The money in these accounts grows tax-free. You won't have to pay capital gains tax or dividend tax each year on the growth of your investments. This means that the total amount of money in your account can grow faster than it would in a taxable account. However, there is a catch. When you start withdrawing the money from these accounts in retirement, you will have to pay income taxes on the withdrawals. But here's the interesting part. If you expect your income to be lower in retirement than it is now, you could end up paying a lower tax rate on your withdrawals than you would have paid on your contributions. This is where the real advantage of tax-deferred accounts comes into play. By deferring taxes until retirement, when your tax rate is potentially lower, you could end up saving a significant amount in taxes over the long term. So if you're looking for a way to reduce your taxable income now and potentially pay less in taxes in the future, consider contributing to a tax-deferred account like a 401k or a traditional IRA. But remember, it's always important to consider your individual financial situation and consult with a financial advisor or tax professional before making any major financial decisions. Tax-deferred accounts can give you a significant boost in your retirement savings, especially if you expect your tax bracket to be lower in retirement. Lastly, we have taxable accounts. These are the accounts that don't come with the tax advantages of tax-free or tax-deferred accounts. But before you dismiss them, let's delve into their unique characteristics and the role they can play in a well-rounded financial strategy. Taxable accounts, such as regular brokerage accounts, don't have the same tax benefits as their counterparts, but what they lack in tax benefits, they make up for in flexibility. You see, with taxable accounts, you're not bound by the same restrictions on withdrawals, which makes them an excellent choice for those looking for more accessible funds. So, how does tax apply to these accounts? Well, you pay taxes on the income you deposit into these accounts, and you also pay taxes on any capital gains when you sell your investments. That might sound like a bummer, but remember, there's no such thing as a free lunch in the world of finance. However, the tax isn't always a disadvantage. Here's why. If you hold on to your investments for over a year, you'll be taxed at the long-term capital gains rate, which can be significantly lower than your regular income tax rate. So in a sense, taxable accounts can provide a tax advantage, but it depends on your overall investment strategy and your individual circumstances. Moreover, taxable accounts offer no limit on how much you can contribute each year. This means that if you've maxed out your contributions to your tax-free and tax-deferred accounts, you can still continue saving in a taxable account. And let's not forget about the flexibility of investment options. Taxable accounts often have a wider range of investment choices, allowing you to tailor your portfolio more precisely to your financial goals and risk tolerance. While taxable accounts don't offer the same tax advantages, they can provide more flexibility and are an important part of a diversified saving strategy. They're like that versatile player in a sports team, not necessarily the star, but certainly someone who brings value to the table. So don't discount taxable accounts. They might just be the missing piece in your financial puzzle. So how much should you be saving in these accounts? This is a question that has likely been echoing in your mind throughout our discussion. Well, let's revisit our key takeaways to provide some clarity. Firstly, we delved into the value of saving and its essential role in securing your financial future. It's not just about stashing money away, but about intelligent allocation of your resources. Next, we explored tax-free accounts. These are an excellent option for long-term savings, especially when considering retirement. The beauty of these accounts lies in their ability to grow your savings without the burden of taxes weighing them down. But remember, there are limits to how much you can contribute each year. Our journey then moved on to tax-deferred accounts. These accounts allow you to postpone your tax obligations, offering immediate tax benefits and enabling your savings to grow unhindered. However, it's important to note that you'll eventually have to pay taxes when you withdraw these funds. Lastly, we examined taxable accounts. While these don't offer the same tax advantages as the former two, they provide greater flexibility in terms of access to your funds. They're particularly useful for short-term goals or as a backup emergency fund. What's important to remember is the significance of diversifying your savings across these different types of accounts. Each has its unique advantages, and the key is to balance them in a way that aligns with your personal financial circumstances and goals. It's like juggling. You need to keep an eye on all the balls to ensure none of them drop. Remember, there's no one-size-fits-all answer. It's about finding the right balance for you. For more resources and tools to help you make these decisions, check out the links in the description below. Remember, the future is in your hands. With the right knowledge and tools, you can confidently navigate your financial journey and create a future that's as bright as the smile on your face when you finally realize you've got this.